Welcome back to the deep dive. It is Wednesday, February 18th, 2026. And I have to say, just looking at the screens today, looking at the headlines, scrolling across the terminal, um, it feels like the future didn't just knock on the door.
No,
It feels like it kicked the door down and started, rearranging the furniture without asking.
that's a very good way to put it. It really is.
Yeah.
We often talk about paradigm shifts
Mm-hmm.
in these deep dives. It's a phrase that I think gets thrown around in tech circles so often it almost loses its meaning.
It's jargon.
It's
Yeah.
usually just marketing hype for a new feature,
Yeah.
but today,
Mm-hmm.
today the markets are telling us something.
Yeah.
Something fundamental has really changed. This is not hype. This is capital fleeing one reality and just piling into another.
Absolutely. I mean, we are looking at a sea of red for some very specific, very established industries, and then this massive, almost vertical surge for others. It's chaotic out there. The headlines are all calling it the AI scare trade.
The scare trade.
And honestly, when I first saw that term this morning, I thought, okay, is this it? Is this just another tech bubble bursting? Is this the AI crash we've all been kind of half expecting? But it's not that, is it?
No, it's almost the precise opposite. It's not a crash in the sense of money leaving the system.
Right.
It's a violent rotation. That's the term the strategists at Jefferies are using in the report we're looking at today, a violent rotation. What we're seeing today isn't a rejection of technology.
No.
It's the market finally realizing that the technology actually works. And because it works, the market is betting that human expertise, the very thing we valued and paid a premium for in the service economy for, well, centuries,
Yeah.
is about to undergo a rapid structural obsolescence.
Okay, that is a heavy concept to start with. Structural obsolescence of human expertise. I want to pause on that because it really does sound like something out of science fiction.
It does.
So let's unpack this, because usually when we talk about AI, we're talking about, generating a cool image for a presentation or writing a funny poem or maybe summarizing a long email chain.
Right, good generative
Yeah,
stuff.
exactly. But looking at the sources we have in front of us today, we've got market reports from financial content, these deep quantitative analyses from Jefferies, we've got technical specs on a new product called Hazel, and then this really fascinating, very heavy report from NIST on explainable AI. This feels completely different. This isn't about writing poems anymore.
No, and that's the crucial distinction we have to make right at the top. We have moved past the generative phase, the phase where the novelty was, look, the computer made a picture. We are now firmly, and I mean firmly, in the agentic phase.
Agentic.
And that is what the market is reacting to. An agentic AI doesn't just create content for you to review. It does a job. It executes. It performs complex workflows that previously required a highly trained and highly paid human brain. And the market is reacting to that shift in real time, right now.
And that reaction is, I mean, it's brutal for some. Let's just look at the numbers for a second. We are seeing this massive sell-off in traditional service sectors. Wealth management, commercial real estate, insurance.
The pillars.
These are the pillars of the white-collar economy. I mean, these are the jobs your parents told you to get because they were safe. And today, they are getting absolutely hammered.
Exactly. And at the exact same time, AI infrastructure, the chips, the specialized software that actually builds the AI, is surging. It's effectively a war between hardware and humans. And today, February 18th, 2026, the market is voting very loudly for hardware.
So our mission today for this deep dive is to figure out why. Why today, of all days? Why these specific companies? And maybe the biggest question, what does it mean for anyone out there listening who makes a living selling their advice?
That's the core of it.
We're going to dig into the anatomy of this scare trade. We're going to meet the specific product that seems to have triggered this whole panic, this thing called Hazel. And then we're going to get into the psychological side of it all. I mean, how do you trust a machine with your life savings? Because even if the math works, that trust factor is a whole other beast.
It's a huge barrier. And that's where that NIST report becomes so critical.
Yeah.
But you're right, we have to start with the money. We have to start with what is happening on the trading floor right now.
Let's do it. So, Section 1, the anatomy of the scare trade. I'm looking at this report from Market Minute, and there's a quote here from Mohit Kumar over at Jefferies that it really jumped out at me. He describes the mood today as shoot first, ask questions later.
That sums it up perfectly. It's pure instinct right now. You have to try and put yourself in the shoes of a fund manager in this moment. They aren't waiting to see Q1 earnings. They aren't waiting for some 5-year forecast from these legacy companies. They're exiting immediately. They are looking at the capabilities of these new AI agents, specifically some of the product demos that dropped earlier this week. And they are doing the math in their heads. They're saying, okay, if this piece of software can do X, then company Y, which employs 10,000 people to do X, is in very, very big trouble.
So let's name names, because these aren't small startups that are folding. These are giants.
No, these are the titans.
Yeah.
It's a bloodbath in wealth management specifically.
Hmm.
Charles Schwab is down something like 7 to 10% in a single session.
Which is just insane for a stock like Schwab.
It's a seismic event.
Yeah.
Raymond James, LPL Financial, both down around 8%. Now, just a context set for you, these stocks usually move like ocean liners. They go up 1% or down 1% on a normal day. A 10% drop without a major scandal, without a fraud investigation, without a catastrophic missed earnings call, that is pure, unadulterated panic.
And it's not just Wall Street, right? This is a global story.
It is absolutely global. You look over at London, St. James's Place, which is a huge blue-chip wealth manager in the UK, very respected, it cratered 20%. 20%. 1/5 of its market capitalization just gone in hours. And then you pivot to an entirely different industry, real estate.
Yeah.
CBRE Group, the biggest commercial real estate services firm in the world, is down 16%.
16%. That is wild. I mean, CBRE basically is the concept of commercial real estate services for most of the world.
It is. And the question we have to ask ourselves is, what do all of these companies have in common? Why is the market algorithm punishing Schwab in New York and St. James's Place in London and CBRE, which is everywhere, all at the same time?
Well, they're all middlemen, right? In a way.
Yeah.
They sit between the client and the thing the client wants.
Precisely. But let's be even more specific. They are information brokers.
Yeah.
Think about what a wealth manager does, or a commercial real estate broker, or an insurance agent. Their entire value proposition, the reason you pay them, relies on the fact that the world is complicated.
Right.
The data is messy. The tax code is a nightmare. Commercial lease structures are deliberately opaque. And you, the client, you don't have the time or the specialized expertise to process all that mess. So you pay a premium fee, often a percentage of your assets, or a commission on the deal to process that information for you.
Right. I pay my financial advisor a fee because I don't want to spend my weekend reading the tax code. I pay a real estate broker because I don't know which office buildings in Midtown have vacancies, and I certainly don't know what a good price per square foot is.
Exactly. You're paying for the application of human expertise to complex information. But what the market is betting today is that Agentic AI drives the cost of that information processing and the application of that expertise to zero, or, near zero.
And if the core service becomes free or close to it?
If an AI agent can read the entire tax code, analyze your entire investment portfolio, and find every office vacancy in the city instantly, and we'll get to how it does that in a minute, why are you paying a human 1% of your wealth every single year for the rest of your life?
You're not.
You're not. And that's why the stocks are dropping. The margin is collapsing in real time. The justification for the fee is evaporating.
It's the commoditization of expertise. I think that's the phrase I saw.
That's the phrase. The analysts at Goldman Sachs are actually putting out notes comparing this moment to the collapse of the newspaper industry in the early 2000s. And I think that analogy holds up really, really well.
Oh, that is a chilling comparison for anyone working in professional services.
It is, but it fits, though. Think about it. Newspapers used to have a monopoly on distributing information. If you wanted to reach an audience or just get the morning's news, you needed the paper. The internet completely commoditized distribution.
Right? Anyone could publish.
Suddenly, you didn't need the printing press and the delivery trucks to get the news. The monopoly broke. Now look at professional services today. They have a monopoly on applying expertise. The message is, you can't interpret this law without me. You can't plan this complex portfolio without me. Agentic AI is commoditizing that application. It's the same dynamic, just moving up the value chain from raw information to complex advice.
But the money has to go somewhere. It's not just evaporating from the market. This is a rotation, you said.
Right.
The market cap is shrinking in one sector, but it has to be growing in another.
No, it's rotating.
Oh.
And this is the picks and shovels strategy on steroids. While all these service firms are getting crushed, you have to look at who is winning today. NVIDIA is up over 2%, which is a massive move for a company that size because of a new partnership announcement with Meta for their Blackwell chips.
Right, the hardware, the brains to run the AI.
The picks and shovels. But the really interesting winner today, the standout in my opinion, is Cadence Design Systems. They're up over 9%.
Cadence. Now, I know the name, but remind us what they do exactly.
They make highly specialized software for designing microchips. It's called Electronic Design Automation, or EDA. It's a niche, but it's critical. But here's the kicker, and here is why they are surging while Schwab is tanking. They just released an Agentic AI for chip design,
An AI that designs chips.
an AI that helps humans design chips way faster. They claim it improves engineer productivity by 10 times. So the market is sending a very clear message. We love companies that build the automation. We hate companies that use humans to process data. Cadence is building the tool that builds the chips that runs the AI. That is the ultimate defensive position in this new world.
It's like the market is sorting every company into one of two buckets. You're either one of the automators or you're one of the automated. And today, you really, really do not want to be in that automated bucket.
That is exactly it. The automators and the automated. And the market is ruthlessly and very quickly repricing the risk of being automated.
Okay, so we have this broad sector-wide panic. But panics like this usually have a trigger, a spark. You don't just get a 20% drop in a firm like St. James's Place just on, vibes. And according to our sources, specifically this really good deep dive article from Wealth Management magazine, the spark was a single product launch, a piece of software called Hazel.
Hazel. It sounds so harmless, doesn't it? It sounds like a nice grandmother who bakes cookies and knits you a sweater.
Right. But apparently Hazel is the thing that is absolutely terrifying the boardrooms of these multi-billion-dollar financial firms. So let's meet Hazel. This is a product from a fintech challenger called Altruist.
Correct. And to understand why Hazel matters so much, we have to look at what it actually does. This isn't just a chatbot. It isn't answering generic questions like, what is a Roth IRA? It is an autonomous AI platform designed specifically for registered investment advisors, RIAs. And the feature that launched on February 10th, the one that really seems to have spooked the market, is their AI-powered tax planning module.
Tax planning. Okay, so doing your taxes is miserable. We all know that. It's complicated. It's boring.
It's miserable, it's incredibly complex, and for a human advisor, it is incredibly labor-intensive.
Yeah.
Think about the typical workflow for a high-net-worth client. The advisor has to collect and read through 1040s, analyze W-2s and pay stubs, look at K-1 forms from private equity funds, check the cost basis on dozens of stock trades. It takes hours and hours of high-skill work.
And it's draining. I've heard advisors call it the worst part of their job.
It is slow, it's mentally draining, and because it's done by a human, it's prone to error. You miss a decimal point, you misread a number, and you've made a huge mistake.
And Hazel just does this.
Hazel does it in minutes. The workflow is a client uploads their raw documents, PDFs, even photos of pay stubs, whatever they have. Hazel ingests them. It reads them using optical character recognition and advanced vision models. And then it generates a personalized tax strategy and, this is the key part, interactive scenario modeling.
Interactive scenario modeling. So you can play with it. Like, what if I sell this house in 6 months? What if I retire a year early?
Exactly.
Yeah.
Real time. If you sell this stock in December versus waiting until January, here is the exact tax impact.
Yeah.
If you were to move your legal residency to Florida, here is your estimated savings.
Yeah.
It does the complex math that used to take a senior accountant with a CPA license hours, and it does it instantly.
Yeah.
And it presents it all in a beautiful client-facing dashboard that the advisor can then walk through with them.
And here's where it gets really interesting, or scary, depending on who you are, the price. Because normally this level of sophisticated personalized tax modeling is reserved for people paying huge fees to private banks.
The price is the whole disruption. Hazel costs $60 per seat per month.
60. 60. That's the cost of a gym membership.
It's less than a fancy gym membership in some cities. Now, contrast that $60 with the traditional model.
Yeah.
If you go to a traditional wealth management firm, they charge you based on assets under management, or AUM. Typically, that's 1% of your wealth.
So if I have $1 million saved up for retirement, which, might have taken me a lifetime to save, I'm paying them $10,000 a year. Every single year.
Right. You're paying $10,000 a year. And what are you getting for that? Portfolio management, some general advice, and maybe, if you're lucky, a tax plan that they update once a year. Now, Altruist comes along and says, hey, advisor, you can have a state-of-the-art tax planning engine for $720 a year.
The math just doesn't work for the old model anymore.
It completely breaks.
Yeah.
If Hazel can do the tax planning and other AI tools can do the portfolio rebalancing and the client communication, where is the justification for that $10,000 fee?
It evaporates. It just, poof, car.
It evaporates. That is the $60 problem.
Yeah.
The market is looking at Schwab, looking at Raymond James, looking at all these legacy firms and saying, your margins are based on a world where this cognitive work was hard and expensive. This work is now cheap. Your margins are toast.
And it's not just a basic model, right? I was reading about the underlying architecture of Hazel, this swivel architecture they talk about. This fascinated me because I think a lot of people just assume these companies are just plugging into, ChatGPT and hoping for the best.
Right, like it's just a thin wrapper.
Exactly. But Hazel is way more complex than that.
No, and this is a critical technical detail that makes it so powerful. Gokul Ramanathan, who's the product manager at Altruist, he gave an interview where he described this swivel approach. It's built to address the core problem that, one AI model doesn't fit all tasks perfectly.
So it's like a traffic cop for AIs.
That's a perfect analogy. Or think of it like a general contractor hiring a team of subcontractors. Hazel isn't one single AI model. It's an orchestration layer, a system that intelligently routes different tasks to different specialized models.
Okay, so give me an example.
Sure. So if Hazel needs to interpret a really complex legal document or a new section of the tax code, it might swivel that task over to Anthropic's model because their Claude 3 model is known for handling huge amounts of text and very precise logic exceptionally well.
I see.
But then, if it needs to draft a really empathetic email to a nervous client explaining why the market is down this week, it might swivel to OpenAI because GPT-4 is fantastic at capturing a specific human tone. If it needs to do some deep data analysis or heavy math, maybe it routes that to Google's Gemini model.
So it's always optimizing for the best tool for that specific job instead of trying to use a hammer for every single nail.
Exactly. And critically, it hooks directly into the data. That's the other key differentiator. This isn't happening in a vacuum. It's integrated directly into the custodial data at Altruist. It's plugged into the advisor's CRM like Salesforce. It's connected to their email server.
So it's not just thinking, it has context.
It has total context. It knows your real-time bank balance. It knows you just got a bonus because it's all the direct deposit. It knows your kid is going to college in the fall because it's all the 529 plan withdrawals. It can execute tasks, not just answer questions. That is the definition of agentic. It has agency in the system.
And that's why it's so threatening. It's not a passive tool, it's an active participant. It's doing the job. Which brings us to the inevitable question, the one that probably keeps every white-collar worker up at night. If the software is doing the job, what happens to the human?
This is the perfect transition. This brings us to Section 3, the job market reality check. Because we actually have a source here that is quite revealing. It's a job posting on Indeed for a founding sales development representative for the Hazel AI platform.
Okay, so they are hiring. That's good news, right? The robots haven't taken all the jobs just yet.
They are hiring, yes, but you have to look very carefully at the role. Look at the job description. This is not a job posting for a financial advisor. It's not a job for someone to pick stocks or analyze PE ratios or create financial plans.
No, it says the primary role is generating pipeline and qualifying leads. That's sales.
It is pure sales. And look at the skill set they're asking for. Sales management systems proficiency and familiarity with AI tools to personalize outreach. The target pay is good. It's $115,000 on-target earnings. But the job is to sell the machine.
The job is to sell the machine, not be the machine.
Exactly. The role of the advisor is fundamentally shifting. It's moving away from, I am the expert who knows the tax code, to, I am the relationship manager who knows how to operate the AI. Or in this case, I am a salesperson who gets other advisors to sign up for the platform.
It feels like the prestige, the value is shifting. The value isn't in holding the knowledge in your head anymore. The value is in the distribution of the software that holds the knowledge.
That's it.
It's almost like imagine if doctors stopped treating patients and their main job just became selling diagnostic robots to other clinics.
That's the sales versus service flip. In a world where the service part is largely automated, sales and relationship management become the only human differentiators left. You need a human to convince another human to trust the robot. But you don't need a human to be the robot anymore. The cognitive load has been offloaded to the silicon.
That is a profound shift. And it's not just happening in finance. We touched on real estate earlier, but I want to go deeper into that because the drop in stocks like CBRE and JLL was so significant today. There's this concept in the report that I found fascinating, from WFH to WWA.
Yes, this is a fascinating bit of macroeconomic theory playing out in real time on the stock market.
Right.
For the last, 5 years, we have been obsessing over work from home, or WFH.
Right. Will people ever go back to the office? That was the big question for the future of commercial real estate. Empty office towers, the doom loop in downtowns, all of that.
Well, the market has already moved on to a new, and frankly bigger, fear. Work with AI, or WWA. The logic is brutal, but very simple. If these agentic AI tools like Hazel, but for every single industry, make the average white-collar worker, say, 20% more efficient.
Then you only need 80% of the workers to get the same amount of output. You need 20% fewer people.
Exactly. And if you need 20% fewer workers, you need 20% less office space.
Hmm.
It's a structural reduction in the demand for the physical product that these real estate firms broker. It's no longer about where the workers sit, it's about whether the workers are even needed at all.
Wow. So it's not just that people are working from their living rooms, it's that for many roles, the workers don't exist anymore.
Precisely. And there is a second layer to this real estate crisis, which is maybe even more profound. It's the collapse of the information asymmetry moat.
Yeah.
We talked about this with finance, but it is huge in commercial real estate. How does a broker justify their massive commission fee?
By knowing something you don't.
Exactly. I know this specific lease clause is standard and this one isn't. I know this landlord is desperate to fill a space and will take a lower offer. I know there is a perfect space opening up in that building next month that isn't even listed yet. That secret knowledge is their product.
But if an AI agent can scan thousands of public lease documents, scrape city records for permits, and match potential tenants to available spaces instantly.
Then the broker's secret knowledge is suddenly worthless. It's public. The report calls it the zero marginal cost future for professional advice. If I can get the best lease negotiation strategy from an AI for pennies, why on earth am I paying a broker a six-figure commission?
The moat is gone. The castle is completely undefended.
And the market is repricing the value of that castle accordingly. That's why you see a giant like CBRE down 16% in a day. It is a full-blown existential crisis for the brokerage business model.
So we have painted a pretty stark, maybe even bleak picture here. We have AI doing our taxes, AI negotiating our office leases, and humans are shifting into these sales and relationship roles to pitch the AI. But, and this is a really big but, can we actually trust them?
This is the billion-dollar question.
Yeah.
Literally.
Mhm.
And it brings us to Section 5, the safety valve. Because if I'm going to let Hazel plan my family's retirement, or I'm going to let an AI agent negotiate a multi-million-dollar office lease for my company, I need to know it's not hallucinating. I need to know it's not just making things up.
We've all seen AI do that. We've all seen it confidently state facts that are just plain wrong. I saw one the other day where it invented a Supreme Court case that just didn't exist, complete with fake citation.
Yeah, happens all the time.
You can't have a hallucination on a tax return. The IRS does not accept my AI told me to do it as a defense.
No, they do not. And that's why we have to turn to the National Institute of Standards and Technology, NIST. They've just released a very important technical series publication on what they call explainable AI, or XAI. And this is really the rule book for how these systems have to work if they ever want to be taken seriously in regulated industries like finance or healthcare.
Okay, so what does NIST say? What makes an AI explainable? Is it just about showing the source code? Because that doesn't help me.
No, showing someone millions of lines of Python code isn't helpful to a user at all. NIST breaks it down into 4 core principles, and these are really good standards for us to keep in mind as consumers too. If you're using an AI for something important, you should check if it meets these principles.
All right, what's the first one?
Principle 1 is simply explanation. The system must provide evidence or reasons for an output. It can't just say do this. It has to say do this because.
So for Hazel, it can't just say sell this stock. It has to say sell this stock because its PE ratio is above the industry average and its projected earnings are declining.
Exactly. No black boxes allowed for high-stakes decisions. The system has to be able to trace its own logic. Principle 2 is that the explanation must be meaningful.
Meaningful.
It must be understandable to the specific user. This is crucial. If Hazel gives a tax explanation to your grandmother that only a PhD in machine learning could understand, it fails this principle. It has to be meaningful to the client, not just the developer.
Right. If it spits out a bunch of weights and biases from the neural net, that doesn't help me understand why I should rebalance my portfolio. I need it in plain English.
Precisely. It has to speak the user's language. Principle 3 is explanation accuracy. The explanation must honestly reflect the actual process the AI used to make the decision. This is meant to address a very sneaky problem called fair washing.
Fair washing. That sounds like a marketing term for something bad.
It's a nasty little trick. It's where an AI makes a decision that is actually biased. Maybe it denies a loan based on a proxy for race or zip code, which is illegal, but then it generates a fake, plausible-sounding explanation that looks fair. Oh, we denied the loan because of their debt-to-income ratio.
Wait. So the AI can lie about why it made the decision.
If the model is optimized to be persuasive or socially acceptable, then yes, it absolutely can. It can generate a post hoc rationalization that isn't the true reason. NIST says no. The explanation must accurately reflect the actual reason, even if that actual reason is ugly or reveals a flaw in the model.
That seems incredibly hard to police, but absolutely vital if we're going to trust these things.
It is vital. And finally, the fourth principle, knowledge limits. The system must know when it doesn't know.
Ah, I love this one. The humility principle for robots.
It's so important. If an image is too blurry to positively identify a bird, the AI must say, I don't know, or confidence is low. It shouldn't just guess it's a cardinal. If the financial data provided by a client is incomplete, Hazel shouldn't guess their tax liability. It should say, I need more data to make an accurate assessment.
This all sounds great on paper. These four principles seem like a solid foundation. But there was a section in this NIST report that really surprised me. It was where they compared AI explanations to human explanations. And it turns out we aren't exactly the gold standard of rationality we think we are.
Chuckles. No, we certainly are not. That's Section 8 of the report, Humans as a Comparison Group. And reading it is a very humbling experience. It discusses a cognitive bias called the introspection illusion.
The introspection illusion, it sounds like a magic trick.
It's a trick our own brains play on us every single day. The research they cite shows that we humans are actually terrible at explaining our own decisions. We suffer from something called choice blindness, meaning in studies, people will vigorously defend choices they never actually made if you trick them into thinking they did. And even more commonly, we engage in post hoc rationalization. We make a decision based on gut feeling or emotion or a subconscious bias, instantly, in the blink of an eye. And then afterwards, our conscious, logical brain invents a plausible reason for why we did it.
So if I buy a stock because I liked the color of the company's logo or because I saw a good tweet about it, my brain might tell me, and I'll tell you, oh, the fundamentals were strong and I really like their free cash flow.
Exactly. And you will 100% believe it. You aren't lying on purpose. Your brain is rationalizing to create a narrative that makes you feel like a rational, intelligent actor.
So wait, we are holding AI to a standard that we ourselves don't even come close to meeting. We want the AI to be perfectly logical and transparent while we are running around making huge financial decisions based on, vibes.
That is the deep insight here. We accept gut feeling from a human broker. We even pay a premium for it. We call it instinct or experience. I just have a good feeling about this deal, they'll say. But we demand mathematical proof from Hazel. We are, in effect, holding the machine to a standard of truth and explainability that is fundamentally superhuman.
Which is probably necessary, right? Because if the machine is going to be scaling this advice to millions of people at once, a machine gut feeling could crash the entire economy.
Oh, absolutely. The risk is what's called model risk, using a tool outside of its safety zone. If we don't have this standard of explainable AI, we're just trading our own messy human biases for a new, opaque black box algorithm that we can't question. And that is incredibly dangerous. But it is deeply ironic, isn't it?
It really is. And this brings us to the bigger picture. We've talked about the stocks, the product, the jobs, the safety, but who owns this future? We have another source here, a research paper on frontier AI and the concentration of power. And it talks about something called the Palo Alto system.
Yes. This paper is really a critique of how this entire ecosystem is being built. The Palo Alto system is the term they use to refer to the concentration of power over AI development in a very small geographic area driven by a very specific ideology: corporate capture and blitzkrieg-style scaling.
Blitzkrieg scaling, that sounds like move fast and break things.
It's move fast and break things, but applied to the fundamental infrastructure of our society. The critique in the paper is that these incredibly powerful tools like Hazel and like the foundation models from OpenAI and Google and Anthropic are being assetized for profit above all else. They aren't necessarily being built for the public good. They are being built to generate massive returns for venture capital investors.
Which explains why the market loves them today and hates the old guard. The market rewards that kind of ruthless efficiency and profit extraction.
Right. But the paper points out a deep conflict. Policy and governance around AI is being dominated by the global north, primarily the US, and by powerful corporate interests. This tends to sideline the major societal hazards, like mass labor disruption. We're sitting here talking about the scare trade as a financial event lines on a chart going up or down. But for the millions of people working in these service jobs, it's a livelihood event.
It's their mortgage. It's their kids' college tuition.
Exactly. The market celebrates the efficiency. The worker feels the disruption. And the paper argues that we are essentially letting corporate prerogatives steer the entire governance agenda. We're focusing on AI safety in terms of, will the superintelligent robot kill us all one day? Rather than the more immediate question of, will this robot take 20% of the jobs and concentrate all the wealth in the hands of 3 tech companies?
So given that reality, what happens next? If the old guard, the big banks, the brokerages, the Schwabs and CBREs of the world are losing, what is their move? Do they just roll over and die?
No, of course not. They panic, and then they buy. The analysis from both Financial Content and Jefferies predicts we're about to enter a panic M&A phase.
M&A, mergers and acquisitions.
The AI losers, the traditional incumbent firms, will likely try to buy their way out of this existential hole. They will go on a shopping spree for startups. They will try to acquire technological defenses to protect their old business models.
So you could see a company like Charles Schwab trying to buy a cutting-edge AI lab, or a big real estate firm trying to buy a data platform that does what they used to do.
Exactly. But it's going to be incredibly expensive. And it's going to be messy, because trying to integrate a fast-moving, nimble AI startup into the bureaucracy of a 100-year-old bank is like trying to put a Ferrari engine into a horse-drawn carriage. The cultures are completely different.
So the verdict from the analysts is that firms have to pivot, not just buy.
They have to fundamentally change their identity. They have to stop being providers of answers and start being managers of AI systems. It's a complete shift in mindset.
Hybridization or extinction.
That's the binary choice facing a lot of these companies today.
Yeah.
Look at the companies that are winning. Look at a company like Figma. They had earnings recently, and the stock soared. Why? Because their tagline is, Figma gets better as AI gets better. It's a tool that integrates AI to help human designers be more creative. It uses AI as a lever, as a force multiplier.
As opposed to a company like, say, DoorDash.
Right. DoorDash is struggling with very high investment spend. They have to spend an absolute fortune to build out the logistics AI, and the margin payoff for that massive spend isn't as clear yet to the market. The winners are the ones where AI is a clear force multiplier for their core product, not just a massive cost center, or even worse, a direct replacement for their core human-led service.
So bringing it all back to today, February 18th, 2026, this date really does feel significant. It feels like the end of the hype era and the beginning of the reality era for AI.
I think that's the perfect way to put it. We are moving from speculation to surgical de-risking. The market is no longer just throwing money at any company with .ai in its name. It is now surgically identifying and cutting out the businesses that look most vulnerable to this new wave of automation. Hazel proved that complex, high-fee professional work can be automated and sold for $60 a month. You can't unring that bell.
You absolutely cannot unring that bell. The human touch premium, that extra fee we've always paid for a handshake and a reassuring smile, feels like the value of that has just crashed.
It has. And it leaves us with a final and, I think, a somewhat provocative thought to end on. We talked about the introspection illusion from that NIST report. We talked about how we humans are fundamentally unreliable narrators of our own decisions. We just make things up to sound smart and rational.
Right. We're flawed. We're biased.
We are. So if we are now handing over complex reasoning to Agentic AI, and if we succeed in forcing that AI to be truly explainable and honest, according to those strict NIST standards, are we by accident actually moving toward a more honest world?
Wow. That is a thought. I hadn't considered it that way.
Well, think about it. Are we trading our messy, emotional, post hoc human rationalizations for these black box algorithms that we are frantically trying to force to tell the truth, the whole truth, and nothing but the truth? If the AI actually follows the rules of XAI, it might be the first time in human history we get financial advice that isn't influenced by what the advisor had for lunch, or their own commission structure, or their ego.
So we're outsourcing our rationality. We're trading a cold, hard, but maybe honest machine for a warm, fuzzy, but demonstrably biased human.
It's the trade-off of the century. And today, the market voted, loud and clear, for the machine.
The market voted for the machine. Well, on that note, I think we all need to go and take a very close look at our own portfolios.
I certainly will be checking mine as soon as we're done here.
Check your exposure to information brokers, everyone. It is a brave new world out there. Thanks for listening to The Deep Dive. We'll see you next time.